Hi guys, and welcome to another week ahead video. Now in this week our attention will turn to the US dollar. The US dollar has had a little bit of a roller coaster ride in the last couple of weeks. We've seen some massive depreciation and appreciation across the board. In this week we have a couple of very important economic data points that comes up, and we think all of them has the potential to really move the dollar in this week. So jump with me now to the video to see exactly how we can prepare for these events and hopefully trade them in the week as well. Okay, then looking at the baseline for the US dollar. Now from this chart we can see that the dollar has had quite a roller coaster ride over the last couple of weeks. Now at the end of February we saw some of the quickest equity market declines in history as the economic gravity of the coronavirus started to set in. Now that caused markets to aggressively price in lower interest rates as well as softer monetary policy for most of the central banks across the globe. Now as the Federal Reserve had much more room to the downside compared to some of the other central banks like the ECB and the BOJ, etc. This saw the dollar slide against most of its peers, with the dollar index falling close to 6%. Now, this also led to the Federal Reserve announcing 2 emergency rate cuts as well as introducing a new QE program. However, these policy measures were not enough to really appease the extreme market uncertainty, and this led to an exacerbated scramble for US dollars across the board as investors dumped everything from equities, commodities, and even fixed income positions to basically just hoard US dollars. Now, that demand for dollars was further increased as banks, governments, as well as companies tried to get cash rich. And despite the Fed actually opening up swap lines with 9 additional countries, that scramble for the US dollar saw a massive dollar gain of over 8% in just 2 weeks. Now, in another sudden turn this week, we saw one of the biggest weekly declines in terms of the dollar index history, going back all the way to 1985. And it was firstly driven lower by the Federal Reserve on Monday announcing an open-ended or unlimited QE program, which in this week alone sent the balance sheet for the Federal Reserve above $5 trillion for the very first time. Now, the combination of the additional swap lines as well as the unlimited QE and the approval of that US $2 trillion stimulus package saw intense demand for that dollar continue to ease throughout the week, which did see some downside for the dollar. As well, we also had economic data that saw more pressure on the dollar, as well as the initial jobless claims that shot up by the biggest amount in the history of the data series, with a print of over 3.2 million. And this chart over here can just give you some perspective of the sheer size of that jump to the upside. Thus, in the short-term bias, we do remain a downside for the dollar, a downside bias for the dollar for now. Now, looking at the upcoming risk events, the US unfortunately has now overtaken China in terms of the confirmed cases for the coronavirus. Due to the spread, a lot of the country has been placed on strict containment lockdowns, and with the cases rising, more measures are expected to come in the coming days. Now, last week, the number of Americans that filed for unemployment benefits rose to a record 3.2 million as workers were unfortunately laid off. But the interesting thing about that was that the US Treasury market, the yield specifically, didn't really blink on the back of that number, and that shows us that the markets have, to some extent, already priced in a lot of the negativity that we're seeing from these incoming data points. Now, these numbers point to a definite recession that the US is going through, and the big question now for markets becomes, from what has already been priced in, how deep and how long will this recession last? That is where the upcoming data points comes in for this week. The upcoming ISM data as well as the slew of employment data points will give the markets a lot to think about in terms of the depth as well as the length of the recession. Now, after the dismal market PMI numbers that we had this week, a lot of attention will be placed on that ISM data points. Looking at the chart, we can see the stark correlation between ISM PMI data as well as that quarterly GDP numbers. When we had that big downturn in PMI numbers going back to the global financial crisis, we also saw a major drop in terms of GDP. Now, the market's already expecting both these data points to come in well below that 50 level. If we do see further downwards moves, that doesn't really bode a very pretty picture in terms of GDP growth. So definitely something that we need to keep track of. Now, before the coronavirus outbreak, the markets were expecting more of a V-shaped recovery in the world economy, but these latest numbers do point to more of a protracted U-shaped recovery in the markets. Now, turning then to the employment data, markets are expecting quite a big contraction for both the ADP as well as the NFP data this week. Now, following the over 3 million jobless claims due to that emergency shutdowns, this shouldn't really come as a surprise to markets. However, markets are also expecting yet another 3 million jump in this upcoming jobless claims report. And this means that April's NFP as well as the NFP data will be much more important compared to the March data that we will get this week. Nonetheless, we did see that the market flash PMI numbers did show sharp reductions in terms of private sector demand and overall business activity, which should also lead to massive drops in staffing numbers even from March. So definitely something that we need to pay attention to. Then looking at the upcoming or potential dovish sentiment shifts now, after the Fed's announcement of that unlimited QE as well as the US $2 trillion stimulus program, the drastic scramble for US dollars has eased somewhat, so much that the Dow has had one of its biggest one-day surges since 1933, climbing over 11%. Now, a continued recovery in equity markets will spur further ease and should also alleviate some of that pressure that we saw from the market trying to hoard dollars, and that can see some downside bias for the dollar. So definitely a first driver that we need to take care of or take note of. Then turning to the economic data, we can see from the expectations that the market's already expecting quite a lot of downside in terms of the ISM and the employment data. The question now will be how long and how deep that recession will be, whether we will see much more bigger moves to the downside as currently expected. Now, this week's 3 million jobless claims are expected to be followed up with yet another 3 million print in the coming week. This shows just the sheer size and the speed of the economic downturn that we're seeing. Now, if we do see a print above that maximum expectation, coming in way above that 5 million and coming in below the expected numbers for the other metrics, that can see some significant downside if we have a very big downside deviation in these significant data points, and that can see some further pressure coming into the dollar in the short term. However, just keep in mind that there has been a lot of breakdowns in terms of traditional market correlations. We've seen both the S&P as well as gold prices rally side by side on that downside move in terms of the dollar, despite the overall risk on flows we had in the market. So keep in mind that any major drops we see in terms of the economic data points will be bad for equities. And that can also lead to further strength in the dollar again as people start to make another flight to safety. So just keep that in mind in terms of the dollar. Looking at the potential hawkish sentiment shifts, this week's positive risk zone saw massive equity jumps to the upside, but according to Nadia Investment Bank, markets are forgetting that bear markets tend to have some of your most brutal bounces or rallies, giving the example of the 20% and 25% rallies we saw in the S&P during the 2008 global financial crisis. Now, if we see bears take back control and push equity significantly lower this week, that should create another round of uncertainty and should also spur some safe haven demands for the dollar. Now, also keep in mind on the economic data, even though we expect worse than expected data to weigh on the dollar in the short term, it might send some investors into cash if they think that the current shock will have a much longer term consequence on the economy. So keep that in mind. Another point to consider is how governments plan to respond to the recent and unfortunate jump again in virus cases and deaths. Some analysts reckon that about 30% of the world is currently under lockdown. And if we see further massive, more stricter lockdowns coming into place, that'll be a big blow to the world economy. And that can also, again, see some flight into dollars. Then looking at how we can trade the US dollar, in the case of a dovish sentiment shift, we could look to pair the dollar against the yen, which should remain well supported in the current overall uncertain risk environment. In the case of a hawkish sentiment shift, we could look to pair the dollar against the CAD, which has remained pressured in the current risk environment, especially with oil prices hitting that 15-year low, as well as the overall risk sentiment keeping high betas pressured, as well as the BOC that also came out with another emergency rate cut on Friday, as well as announcing QE for the very first time. However, as risk sentiment can change from session to session, it'll be important to evaluate the overall risk tone before taking any trades in either the yen or the CAD. Remember that these trade recommendations are based on the current fundamental bias for these currencies at the time of writing and can thus change throughout the week. So make sure to reevaluate whether the short-term sentiment is still valid for these currencies before taking any trades. Then considering some possible economic news to trade into in line with the US dollar. Now we do have that short-term downside bias for the dollar. Thus we can consider selling into some of the upcoming data points like the ISM, jobless claims and NFP that is also expected to have some downside. However, just keep in mind that we need to keep track of any significant and further news about the virus in the US around the globe as well, or any significant weakness in equity markets, as that can spur some short-term dollar demand again, and that'll basically affect that short-term downside bias for the dollar. So definitely something to keep in mind in the upcoming week as well.